Hi, thanks for joining us for another episode of Ask Spurrell CPA. Today we are talking about revenue and direct costs of goods sold. I have Cole here with me again. Cole, you enjoying the nice weather?
Yeah, it's a nice change. Hopefully it sticks around.
Are we past winter?
I'm not going to say it.
You're not going to say
No.
it? Okay. That's good, because I'd fire you if you were wrong. So the quote that we have here today is, Warren Buffett, all-time great investor, accounting is a language of business. The statistic that I'll bring up on revenue and direct cost of goods sold is, Intuit, the makers of QuickBooks, they did a survey of business owners, and they found that 83% of the business owners got a score of less than 70% on basic financial literacy test. So understanding their cash flow, their profit and loss, their balance sheet. The story that we have is business owners, they're not entirely sure what belongs in their revenue and direct cost of goods sold, how many accounts they should have, and this interferes with their ability to really understand their gross margins of the business, and what sort of overhead that they can sustain if they can't understand what the gross margin of that business is. So Cole, what are the questions you think these business owners should be asking?
How many revenue accounts should most businesses have?
I would say most businesses should have 3 or less revenue accounts. Now I'll give you an example. You could have a restaurant, and that restaurant might have a revenue account for every item on the menu. You're just creating a lot of work, and you'll start getting misclassifications. The more revenue accounts, the more accounts you have in general, the more classifications that you're going to have. And at the end of the day, what is that really telling you? We still have items. Remember, you can still do reports on items, but the idea is, from an account, is we should be able to put all of our income and expense accounts on one page and make good decisions from it, not have it on 8 pages. So most businesses is 3. You get a restaurant, it's 1. What are the food sales? Maybe if you sell product and you sell t-shirts or something at the restaurant, maybe that's the second one. Your average contractor, they might have one account for projects and another account for service calls. Maybe you're a dentist, for example. You got an account for what the owner brings in billings, what the associate doctor brings in billings, what the hygienist bring in billings. There's your 3. Right? There could be some circumstances where you should have more, but I would suggest that you probably need less. So yeah, I would say 3 or less.
Should doctors normally separate owner revenue and associate revenue? Yeah,
that's the big one. We talked about having less accounts, but there are some times where you definitely want that separated. And if you're a physician and you have associate doctors working in the clinic, you do want to know how much your billings are, as opposed to what the billings of the associates are. It's going to be a real telling fact on if there's a lot of revenue. Is it because that the owner physician is just being super productive and working a ton of hours, or is it because the rest of the associate team is carrying some of the load as well? That's one thing that I would break up for sure.
Would trades normally separate projects and service work?
That's usually the natural delineation. Usually you're out bidding on larger projects, and that can go up and down, and the service work is kind of trickling in. So you want to understand what the differences are between those 2 items. It's normally a natural part of it, because you're acquiring that business usually in different ways.
Should you have income not related to your core business in the revenue section?
No, you want to make sure that we're not putting things that belong in those other income and expense sections. Remember, we're going to have revenue, we're going to have cost of sales, we're going to have our gross margin, then we're going to have our overhead expenses, and then income from operations. And we still have this other income and expense section. So things like the rental income that you're making off the condo, the dividends that you're getting from the stock portfolio, the gain on any big investments or equipment. We don't need that in the revenue section, because that's not dealing with the core business, and it's really going to interfere with our ability, could interfere with our ability to calculate the margin correctly, because we're often having to back stuff out of what happens. So those items, they belong in the other income section.
Why do direct costs normally fluctuate more than general or overhead expenses?
Yeah, so usually you're looking at your overhead expenses and you're saying, I want to control these, I want to keep these in a certain level. But when it comes to your direct costs, if they go up, that's not necessarily a bad thing. So let's say you're a contractor and you make 33% on every job. You make a third of every job roughly. If you did more work that month, you would expect you had to pay more sub trades and buy more materials, and so they're going to fluctuate more. So usually your direct costs directly fluctuate at a hopefully a predictable margin, depending on how much work that you do.
Are trades normally going to break down labor, subcontract, and materials?
Yeah, those are usually the ones that you want to break down. So, we're looking at labor, we're looking at subcontract, and we're looking at materials. And sometimes the labor and subcontract, they can be very similar, and some might argue why they're broken down. I would say it's, for some internal analysis, there's some, real different tax treatments on how we handle employees of a company versus subcontractors of a company, but also knowing what that labor force is deployed to there is really useful. And same with the materials. There's different tax treatments for material contracts than there are for contracts that have a labor component to them. So I think those are the three that most construction trades want to be breaking down their cost of goods sold into is labor, subcontracts, and materials, and they might end up in a roundabout way having 6, because if they have project and service work, they would have those 3 components that deal with each. So it would be labor on projects, subcontracts on projects, materials on projects, and then labor on service, and subcontracts on service, and materials on service.
What are some of the common cost of goods sold accounts for medical practices?
Most medical practices is the associate physicians. So usually you're going to start with the associate physicians. There, if you do have an associate doctor, most clinics are paying them a percentage of their billings. So if that associate billed $20,000 in the month, they might get 70% of those billings, and they get $14,000. So most of the time it's going to be the associate physician, number one. We run into things like dental practices, and dental practices, they might delineate then how much they're paying the hygienists, which is a different revenue stream, and they can make different decisions based on that revenue stream, as well as dentists. Generally it's the lab costs. Often they'll have big lab expenses that are more like a flow-through expense, similar to a construction guy buying a bunch of materials. So you bought nicer materials on this job, but the labor might not be that more. Dental practice is very much the same way. So lab expenses tend to be a direct cost to sales that you want to pull out of the general medical supplies, the gauze and band-aids and that sort of thing. You want a general medical supplies, but the lab costs, if you're a dentist, you're going to be putting those lab costs in a specific account. We deal with some optometrists, and again, they have the associate doctors, but they'll also want the cost of the glasses and contacts too. That's going to come out of an optometry practice.
What is the risk of having too many accounts?
So the risk of having too many accounts is, I can't get this on one page, number one. I can't get this on one page, so I'm looking at my profit and loss statement, and I don't have one page where I can go to and make big decisions. Can I buy this equipment? Can I hire more staff? Do I have to lay this staff off? Do I have to change my pricing? I want to be able to look at one piece of paper and make that decision. So the other issue, even if you have the ability to interpret the multiple pages, which I think there's too much room for error, there's a reason why big, huge publicly traded companies still have a one-page income statement somewhere in that big package that they get from the auditor. I think it's when you have those too many accounts, you also have these classification error risks. So 1 month you declare it office supplies, the next month you declare it printer ink. Well, come on, how much printer ink are you buying every year? You don't need an account for that. And even if you tracked it, even if you did have that account, you always have that risk where you classified it as one thing, 1 year or 1 month, and the next thing the next year, the next month. So now when you're trying to do some variance analysis from one period to the next, you might think that cost went up or that cost went down, and really no change happened. It was just classified as something different. So the more accounts you have, the bigger the risk you have of a classification error, and the harder it is to interpret the entire big picture to make big picture decisions.
What is gross margin, and why is it more important than total direct cost?
Yeah, so that gross margin is when we have the revenue, and then when we have the direct cost. So if we take that revenue less the direct cost, we get the gross margin. So we have the contractor, and let's say he makes 25% on the job, so he had $10,000 in revenue, and he had $7,500 in direct costs, and there was $2,500 in gross margin. So after he paid those direct costs, what was left over from that job? So that $7,500 expense, it's not a big deal if that goes up or down every month. What's more important is what was the margin left over afterwards. So after we paid for the labor and the supplies and the subcontractors that directly related to that revenue stream, what's left over, what's our margin, is much more important than direct costs, because direct costs going up could be a good thing. It just means we might have sold more that month or bigger revenues in that month.
How does separating and understanding gross margin help you clarify the break-even?
Yeah, so if you just group all these expenses together, you're not going to be able to do a good break-even analysis. And we get to that contractor, he might have $10,000 in overhead expenses, as a receptionist, and he has rent, and he has some office supplies and his insurance, and all of those overhead expenses are $10,000. We have those separated from the direct costs, and he's making 25% on each job. So he needs, in order to cover the $10,000 in overhead expense, he needs $10,000 in gross margin, not on sales. So if we separate the revenue and direct costs, we can figure out what that gross margin is. And in this case, it would be for every $4 at 25%. There's $1 in gross margin. So if he has $10,000 in overhead expenses, if we have them separated, now we know, hey, look, if you want to pay $10,000 in overhead expense, your break even is actually $40,000 a month in revenue. But if you have all those expenses and they're all commingled together, you're never going to get to that number. So it's really important. You got your revenue, you got your costs that directly relate to that revenue stream, you got your gross margin, and then you have your overhead, which for the most part your overhead stays a lot more consistent than your direct expenses, because your overhead stays the same month, same rental space, same reception cost, whatever that is. That doesn't change that much. So having them separate makes it really easy to understand what your break-even point is. So thanks very much for tuning in. That's all the time we have today for this one. So as always, please hit the like and subscribe so we can continue to deliver you tips on how to beat the odds at business. And if you have any questions or if you have any requests for future topics, please leave them in the comments below and we'll address them in a future video. Thanks very much.
Thank you.